Morning, Ron Siegel here with just a quick update today. It is Fed Day. Investors expect to get the first Fed interest rate hike in nearly a decade when the decision is announced at 11 a.m. Pacific time today. I will get to that in a minute. The second factor, which is actually more important, is the beginning of the collapse of the junk bond market. It's horrible. Liquidity has suddenly dried up and it's going to get much worse. If you recall, I spoke of my concern of the shale oil drillers in the U.S. would begin defaulting on their high-yield bonds when they cannot make payroll at the end of this year. Oil is off over $1 today and might continue to fall to $30 per barrel. It costs here numbers between $45 and $70 a barrel for these guys to produce oil. Obviously, they cannot survive if they are selling oil that at around $34 today. They've been staying alive because they used forward hedging to lock in old and higher prices. Those hedges are now expiring and they face the worst of all worlds. While there is not much of any media discussing this being the factor behind the fall of junk bonds, I can tell you that this is very likely the catalyst, and it's only just begun. Back to the Fed, much attention will be paid to the dot plot. It's the technicals. The FOMC members' expectations for the future path of Fed funds rate and accompanying statement at the press conference. It's about 11:30 today. Mortgage bonds are near unchanged to begin the day, and there may not be much improvement ahead of the release. Even better than expected housing data did little to influence mortgage bonds. November housing starts rose to a seasonally adjusted rate of 1.173 million units versus the 1.135 million expected, up 10.5% from October, while building permits rose to 1.289 million units versus the 1.15 million expected, up 11% from October. Technicals take a backseat to the big event of the day, the Fed decision, but it's important to know where prices can go if bond violates support. When you take a look at the chart that we look at, prices are holding above support at the black dashed line, a level in place since June. If the bonds hold that level, we could see prices edge higher, which means rates lower, and maybe revisit tough resistance at the 200-day moving average. However, if prices falter, rates increase and fall beneath that black line, the bond will likely drop quite significantly. Bottom line, I believe the Fed will raise rates today. I also believe the market has already priced in a rate increase, and that ultimately bonds will rally to new highs, bond prices, and new lows for interest rates. However, the opposite may happen immediately and for some days following the announcement. Ultimately, an increase will hurt the stock market and will drive money back to bonds. Also, long-term bond buyers care only about inflation. If they don't see inflation, they don't care what the Fed does, and they will buy bonds, which brings rates down. I will be chatting more about this on the radio program in just a little bit, but I wanted to get this out to you right now, and we'll try and get it posted before the show starts. Have a great day. Look forward to chatting with you, Ron Siegel. RonSiegelRadio.com if you need me. Take care. Bye.